Thanks for staying with us on the News at 1. Let's take a look at your market news now. Asian markets reversed gains today, tracking losses on Wall Street as investors fret about rising US Treasury yields and whether this may give rise to further interest rates. Technology stocks also took a beating as Google's parent company Alphabet sounded the alarm on rising cost worries. Now, despite a weaker yen, this was unable to provide support to Japanese equities. Pharmaceutical giant Takeda plunged 7% after it raised its offer for Irish rival Shire. The Nikkei share average ended 0.3% lower. Hong Kong stocks also hit the skids with the Hang Seng index declining 1.0%. China didn't escape the downturn. The Shanghai Composite Index finished down 0.4%. US stocks slid last night as US 10-year Treasury yields hit 3% for the first time in 4 years. This stoked concerns over higher borrowing rates for company, making the cost of doing business more expensive. First quarter results are also said to have fallen short of expectations. The Dow Jones Industrial Average fell 1.73%. The S&P 500 lost 1.34% and the Nasdaq Composite Index dropped 1.7%. For more on the markets, we cross to Nompumelelo Siziba. She's standing by at the Johannesburg Stock Exchange. Good afternoon, Nompumelelo. Over to you.
Thanks very much, Nzinga. Yes, well, as you mentioned, global markets in somewhat of a tiz around those US Treasury, specifically the 10-year US Treasury breaching 3%. That basically is indicative of the possibility of higher interest rates in that particular economy, and this will be on the back of expectations around higher inflation and so on. So that generally has the effect of seeing the US dollar firm and puts the emerging market currencies like the South African rand on the back foot. And so we've seen that indeed the rand has weakened quite substantially further on yesterday's losses. We're seeing it hovering around 12.45 against the US dollar. Not that long ago it was trading just below 12, so quite amazing indeed. And in terms of the all-share index, it's pretty much in line with global markets. It's in negative territory at the moment. Let's take a look at the indicators. I'm joined by Michael Trehan. He's from Vestat. Thanks for joining us, sir, as always.
Always good to be here, and it's a short week this week, so even better.
Yippee-yee. So there appears to be a lot of anxiety around earnings reports coming out of the United States. They've had very good earnings, returns on average of about 20% and so on. Do you think that this concern is a little bit overdone, or do you think that there is, there is an argument to say that they can't get these kind of good results for so long, especially when in Europe they're only getting returns of about 1.5%?
Yeah, so look, I think time will tell if these concerns are valid or not. I do think that analysts haven't fully yet appreciated the tax cut that's come into the US. It's quite a substantial drop when you go from 35% to 21% tax rate, and that those profits then come through to the company and shareholders and allows for reinvestment. So we'll have to see. You guys were talking about Google last night. That they had record numbers, but it's the cost of doing business is going up. So yeah, a bit of both. Some US companies, Verizon had good numbers yesterday. Other US companies struggling a bit. So Caterpillar, for example. So yeah, you got to pick your sectors, I suppose.
When companies talk about the cost of business rising, are they talking specifically about interest rates? Because if you look at companies like Google and the mothership Alphabet, I mean, they're sitting on so much cash. Surely they wouldn't really need to borrow to do things like capital expenditure and run their companies.
Yeah, so in Google's case, they actually pay companies to put ads on their sites. So mobile ads are more expensive than PC ads because the mobile ad you can't get away from because it pops up on your screen generally. So they're having to pay more because people are moving from desktops to mobile. So that's where their increased costs are coming from. They pay the likes of Apple money for people to use Google search on Safari, for example. So all those costs have been increasing costs of doing business. It's the other costs are in line with general growth.
Okay, nicely explained. Thanks, Michael. And then in terms of the US Treasury, 10-year Treasury bond, the yield has breached 3%, and this has set global markets into a frenzy. Just explain why. I tried to explain it, but I'm not the expert you are. Why is this, and what impact could it have on emerging markets if sustained?
Yeah, so there's a dual effect here. So the first is from just an asset allocation point of view. As soon as interest rates increase on bonds, they're more attractive to pension funds because you don't have to invest in equities, which are risky. You can take that money and put it into bonds and get a fixed 3% back, whereas 2 years ago you were lucky to get 0.5% back from bonds. So bonds all of a sudden become more attractive, and if bonds are more attractive, it means money flowing into bonds has got to come from somewhere, and that means people sell down stocks to then put that money in bonds. So that's the first part. The second part is from the business perspective themselves. Increased borrowing costs means less growth, which means increased interest payments. The business is just less profitable in general. So it's a bit of a dual impact. At low rates, though, at the moment, at 3%, it's not exorbitant. And history actually shows when interest rates are about 3%, businesses are still fine. Generally, a 3% interest rate is linked with quite a strong underlying economy. So as much as businesses are paying more for borrowing costs, they've got a very strong economy to sell their products to, and that compensates for the increased interest.
Okay. And then the oil price. Yesterday, it hit a 3.5-year high, breaching $75 a barrel. But we've recently learned that US inventories are back up again. We know that, it's very frenetic. Sometimes they're up, sometimes they're down. But my question really is, do you think that the oil price can really go much beyond the $75 a barrel level, given that the US obviously does put a lot of oil into the market?
Yeah, so there's you go look at your demand and supply metrics, and at the moment demand's growing substantially because of good global growth. On the supply side, the US can't produce as much oil as they want because they're just growing too quickly, and pipelines actually can't handle the oil that's being produced at the moment. So you have a look at like the Permian Basin, which is one of the main fracking areas. Oil there is $67 cheaper than at the ports because they can't transport it. So you've got a supply lock or bottleneck, and you've got demand coming through, and that's a great position if you want to sell oil, because it means the price is going to go up. Throw into the mix you've got political uncertainty with Iran and what is Donald Trump going to do, because if they've got sanctions there, it means Iranian oil that's been pumping will probably stop pumping, and then again you've got less supply, increased demand. So yeah, it's very volatile short term. And if you're an investor, if you can stomach the volatility, then maybe it's worth looking at. But from our experience, most private investors can't stomach ups and downs, and it's probably better just to avoid it in general. Steer
clear. All right, unfortunately we've run out of time. We were going to look at the PSG results, but we'll just leave it there. Thank you so much, Michael. Michael Chauhan, he's a portfolio manager at Vestat. After a short break, and Zinga with more business news for you.